How does climate change impact global agricultural markets? Imagine a world where weather patterns no longer follow the seasons we know. That's what climate change is doing to our global food systems. It's not just about warmer temperatures. It's about how these changes ripple through farming, trade, and investments worldwide. When temperatures rise and rainfall becomes unpredictable, crop yields can drop significantly. For example, in regions like Africa, Asia, and parts of the United States, maize and soybean harvests are expected to decline by the end of the century if emissions stay high. Meanwhile, some northern areas might see longer growing seasons and slightly better yields, but these gains often don't make up for losses elsewhere. Water availability is another big concern. Changes in rainfall cause both droughts and floods, which disrupt irrigation and reduce farm productivity. Small farmers in Asia and sub-Saharan Africa are especially vulnerable because they're relying heavily on rain-fed agriculture. When water supplies fluctuate, food prices tend to become more volatile on global markets. Pests and plant diseases also spread more easily as the climate warms, threatening crops in new regions. This adds more risk for farmers and investors alike. When yields fall, land values in affected areas can decrease, making farmland investments riskier. Conversely, regions less affected or even benefiting from climate shifts might attract more capital. Farmers and investors are now looking at how to adapt by developing drought-resistant crops, improving irrigation systems, and adopting sustainable farming methods. These strategies help stabilize production and protect investments. On a larger scale, climate change shifts the balance of agricultural power. Countries like the United States might lose some export market share to nations like Brazil and Argentina, where climate impacts are less severe or sometimes even favorable. Agriculture also contributes to greenhouse gases, creating a feedback loop that worsens climate change. This pushes the sector to adopt more eco-friendly practices, which can influence costs and investment choices. For farmland investors, understanding regional climate projections and crop vulnerabilities is essential. Choosing areas with resilient farming systems and access to innovation can help buffer climate risks. Markets will favor regions that can adapt quickly and efficiently. To sum up, climate change is making crop yields less predictable, shifting global competitive advantages, increasing price swings, and raising risks for farmland investments. Staying informed and planning for these changes is key to navigating the future of agricultural real estate successfully.